It's 2021. Or maybe it's 2024 or 2025. Pick your year. You're scrolling through social media and you see it. Someone you went to high school with, someone who was, let's be honest, not the sharpest tool in the shed, is posting pictures of a brand new car, or a vacation in Dubai, or a screenshot of a portfolio with gains so big they look like a typo. The caption, "Crypto changed my life. $100 to $100,000 in 6 months. Thank you, insert random coin here." You look at your own portfolio. You've got some index funds, some boring REITs, maybe a little bit of cash, your gains this year. Respectable, boring, like watching paint dry. And you think to yourself, am I doing this wrong? Am I missing out? Should I be in on this? You feel the FOMO creeping in. You feel the itch. You want the excitement. You want the thrill. You want to be the one posting the screenshots. Here's the thing, I get it, I really do. Excitement is fun. Boring is, well, boring. But here's what most people don't realize until it's too late. Excitement is the enemy of wealth. The most exciting investments, the ones with the biggest stories, the biggest personalities, the biggest promises, are almost always the worst places to put your money. And the most boring investments, the ones that put you to sleep, the ones that make you wonder if anything is even happening, are the ones that build real, lasting wealth. There's a reason for this. It's not an accident. It's not bad luck. It's math. It's psychology. It's the fundamental nature of markets. And if you don't understand it, you will be the one posting screenshots of losses instead of gains. Hi, what's up? I spend way too much time thinking about why we're drawn to shiny objects that destroy our wealth. If you're someone who's ever felt the FOMO of watching an exciting investment skyrocket while your boring portfolio just plods along, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Most people think investing is about having a lot of money. The truth, it's about what you keep. And what you keep is determined by what you don't lose chasing excitement. I'm building a community at the Frugal Investor newsletter where we strip away the hype and focus on high-impact, low-cost wealth building. Get your copy, the 15-day blueprint for wealth and financial autonomy, and join a group of like-minded investors who prioritize long-term gains over short-term trends. Link is in the description. Let's start by defining the boredom benchmark. The boredom benchmark is a simple concept. It's the return you get from investments that are so boring, so predictable, so unremarkable that they never make it into conversations. They never trend on Twitter. They never get featured on TikTok. They never make your friends jealous. What are these investments? Total stock market index funds, VTI, VOO, etc. They just track the entire market, nothing special. REITs, real estate investment trusts. They own buildings, they collect rent, they pay dividends, thrilling, right? Treasury bonds, loans to the government, the definition of boring. Dividend aristocrats. Companies that have paid increasing dividends for 25+ years. They're like that reliable friend who always shows up on time. These investments historically return between 7% and 10% per year over the long term. Not flashy, not life-changing in a week, but consistent, reliable, boring. Now let's contrast that with exciting investments. Crypto coins with dog logos and celebrity endorsements. Meme stocks that get pumped on Reddit. NFTs of cartoon monkeys. Penny stocks of companies that don't actually do anything. These investments can go up 1,000% in a month. They can also go to zero in a day. They're exciting because they're volatile. They're exciting because you never know what's going to happen. They're exciting because they're essentially gambling. Let's do some math, because the numbers tell the story. Take a boring S&P 500 index fund. Over the last 30 years, it's returned about 10% annually on average. If you invested $10,000 in 1994 and did absolutely nothing, you'd have about $174,000 today. Not bad. Now let's look at crypto. Bitcoin is the poster child. If you'd bought $10,000 of Bitcoin at any point and held, you might have done well. But here's the thing. Most people don't buy and hold. They buy when it's exciting, which is usually near the top. According to a study by Chainalysis, over 80% of Bitcoin traders lose money. Not because Bitcoin itself is a bad investment, but because they trade it. They try to time it. They get excited. They buy high and sell low. Now let's look at the exciting coins, the ones that pop up overnight. According to data from CoinGecko, of the top 10,000 cryptocurrencies that have existed, over 90% have failed. They're dead. Zero, nothing. That $100 investment in a random altcoin, probably gone. Here's a statistic that will blow your mind. According to a study by the Bank for International Settlements, only about 1% of cryptocurrencies have survived and maintained value over the long term. That's a 99% failure rate. Now compare that to the stock market. Since 1926, the U.S. stock market has had positive returns in about 70% of all 10-year periods. Over any 20-year period, it's been positive 100% of the time. Boring wins every time over time. Now let's talk about the brain, because this is where the real trap is. Your brain is wired for novelty. It's wired for excitement. It's wired to pay attention to things that are new, shiny, and potentially rewarding. This is an evolutionary adaptation. In the savannah, paying attention to a new sound or a moving bush could save your life. In the modern world, this wiring gets hijacked by the financial industry. They know that exciting investments grab your attention. They know that stories of overnight millionaires make you click. They know that FOMO is the most powerful force in retail investing. There's a concept in psychology called the dopamine loop. When you see something exciting, your brain releases dopamine, the feel-good chemical. When you buy an exciting investment and it goes up, you get another hit. When you check the price and it's up again, another hit. It's addictive. But here's the problem. The same loop that makes you feel good when it's going up makes you feel terrible when it's going down. And it makes you do stupid things, like selling at the bottom. Boring investments don't trigger this loop. You don't check the price of your index fund every hour. You don't get dopamine hits from a 0.2% move. You don't feel the thrill. But you also don't feel the panic. You don't make emotional decisions. You just hold. And holding is the most important thing you can do. Let me tell you a story about two investors. We'll call them Chad and Bob. Chad is exciting. He's on Reddit. He's on Twitter. He knows all the coins. He knows all the plays. He's in on the ground floor of the next big thing. He's made money. He's lost money. But he's always in the game. In 2021, Chad makes a killing on meme coins. He's up 500%. He feels like a genius. He quits his job. He buys a sports car. He posts screenshots. In 2022, the market turns. His coins crash 90%. He holds because he's a true believer. They crash more. He sells at the bottom. He's lost almost everything. He goes back to work. He doesn't post anymore. Bob is boring. He buys an S&P 500 index fund every month like clockwork. He doesn't check the price. He doesn't read the news. He doesn't care about the latest coin. He just buys and holds. In 2021, when Chad is up 500%, Bob is up maybe 20%. Bob feels slow. Bob feels left out, but Bob keeps buying. In 2022, when Chad loses everything, Bob's portfolio is down maybe 15%. Bob doesn't panic. Bob keeps buying. Now it's 2026. Bob's portfolio has recovered and grown. He's up over 100% from where he started in 2020. He has a nice nest egg. He's on track for retirement. Chad is starting over, again. Same starting point. Different strategies, different outcomes. The difference wasn't intelligence, it wasn't luck. It was excitement versus boredom, and boring won. Let's look at the broader data. Because this isn't just about crypto, it's about the fundamental principle of investing. According to the SPIVA scorecard from S&P Global, over 90% of active fund managers fail to beat their benchmark over a 15-year period. These are professionals. These are people with teams of analysts, with access to data, with years of experience. And they can't beat the boring index. What chance do you have, trading crypto in your bedroom at 2 a.m.? Here's another one. A study by Dalbar found that the average investor significantly underperforms the market. Over the last 20 years, the S&P 500 returned about 9.5% annually. The average equity fund investor returned about 5.5%. Why? Because they buy high and sell low. They chase excitement. They get out when it's boring. The gap between what the market returns and what investors actually earn is called the behavior gap. And it's huge. It's the cost of excitement. Let's look at a specific boring investment, REITs, real estate investment trusts. REITs own properties, apartments, offices, warehouses, shopping centers. They collect rent. They pay dividends. They're about as exciting as watching grass grow. But here's the thing. According to NAREIT, the industry association, REITs have delivered an average annual return of about 11% over the last 50 years. That's slightly better than the S&P 500. And they've done it with less volatility in many cases. Now look at the exciting real estate plays, flipping houses, crypto real estate tokens, timeshares. These are marketed as exciting ways to get rich in real estate, and they almost always lose money for the average person. According to a study by the Federal Reserve, over 60% of house flippers lose money when you account for all costs. Timeshares have a default rate of over 30%. Crypto real estate tokens, many have turned out to be outright scams. Boring REITs beat exciting real estate every time. This is where it gets really interesting. Boring investments have a secret weapon, compound interest. When you invest in something that goes up and down wildly, compound interest doesn't work the same way. If you lose 50% one year, you need to gain 100% the next year just to break even. That's hard. But when you invest in something that goes up steadily, even if it's slow, compound interest works its magic. Let's do the math. Investment A, exciting, goes up 100% one year, down 50% the next. Start $10,000. Year 1, $20,000. Year 2, $10,000. Total return after 2 years, 0%. Investment B, boring, goes up 10% each year. Start $10,000. Year 1, $11,000. Year 2, $12,100. Total return after 2 years, 21%. Boring wins. Even though the exciting investment had a huge year, the volatility destroyed the compounding. This is the volatility tax. Exciting investments charge it, boring investments don't. Okay, so you're convinced. You want to be boring, you want to stop chasing excitement. How do you actually do it? Step 1, automate everything. Set up automatic investments into your boring funds. Every month, on the same day, money moves from your bank to your brokerage to your index funds. You don't think about it. You don't decide. You don't get excited. You just do it. This removes emotion from the equation. You're not investing when you feel like it. You're investing because it's Tuesday. Step 2, stop checking. Uninstall the apps. Turn off the notifications. Check your portfolio once a quarter, maybe once a year. The less you look, the less you'll be tempted to do something stupid. A study by Fidelity found that the best performing investors were dead people. Not literally, but accounts that were forgotten outperformed accounts that were actively managed. Because the owners didn't do anything. They were too bored to mess it up. Step 3, define your benchmark. Your benchmark shouldn't be the latest crypto millionaire. It shouldn't be your friend who got lucky on a meme stock. Your benchmark should be the market. If you're matching the market, you're doing great. If you're slightly behind, who cares? Over time, you'll win. Step 4, create an excitement budget. If you absolutely must play with exciting investments, allocate a tiny portion of your portfolio, no more than 5%, to a fun money account. This is your gambling money. You can do whatever you want with it. Buy crypto, trade options, bet on meme stocks. But here's the rule. When it's gone, it's gone. You don't add more. And you never, ever let it affect your boring portfolio. This satisfies the dopamine loop without destroying your wealth. Step 5, read history. Read about the tulip mania of the 1600s. Read about the South Sea bubble. Read about the dot-com crash. Read about the 2008 financial crisis. Read about the crypto winter of 2022. Every generation has its exciting investment. Every generation thinks this time is different. It never is. The names change, the technology changes, the hype changes, but the pattern is always the same, and the boring investors who sit on the sidelines always win in the end. Here's the final piece, the one that might actually change your mind. In a world where everyone is chasing excitement, being boring is actually countercultural. It's contrarian, it's rebellious. When your friends are losing money on the latest crypto crash, you'll be the one quietly building wealth. When they're stressed about their portfolio, you'll be sleeping peacefully. When they're starting over at 50, you'll be retiring early. Boring becomes exciting when you look at the results. Think about it. What's more exciting? A 500% gain that turns into a 90% loss, or a steady 10% gain every year for 30 years that turns $10,000 into $174,000. The second one, obviously, but it doesn't feel exciting in the moment. That's the trap. You have to trade the feeling of excitement now for the reality of wealth later. The final shift is identity. You have to stop thinking of yourself as a trader and start thinking of yourself as an owner. Traders buy and sell. They're excited by movement. They're in and out. They're always looking for the next thing. Owners buy and hold. They're not excited by daily price changes. They own businesses. They own real estate. They own a piece of the economy. They're patient. They're boring. Which one builds wealth? Owners every time. When you buy an index fund, you're not buying a ticker symbol. You're buying a piece of every company in the market. You're an owner. When you buy a REIT, you're not buying a stock. You're buying a piece of buildings. You're an owner. Owners don't panic. Owners don't trade. Owners get rich. Look, I'm not saying you should never take risks. I'm not saying crypto is evil. I'm saying that the odds are stacked against you when you chase excitement. The most successful investors in history, Warren Buffett, Jack Bogle, the list goes on, are boring. They buy things they understand. They hold them forever. They don't check prices. They don't chase trends. They just sit there. And they get rich. You can too. It's not complicated. It's not exciting. It's simple. Buy boring, hold boring, get rich boring. The next time you feel the FOMO creeping in, the next time you see someone posting screenshots of their 100x gain, remember this. You're not seeing the losses. You're not seeing the crashes. You're not seeing the ones who lost everything. You're seeing the highlight reel, and the highlight reel is not reality. Stick with boring. Your future self will thank you. I really hope this video brought you some value today. If it did, comment more down below. I'm reading through those to decide what topics to cover next, so definitely let me know if you want more of this. Embrace the boredom, build the wealth. And I'll see you in the next one.